Welcome to Lesson 2, Credit Card Finance Charges. Our objectives today are to become familiar with the terminology related to credit cards and their finance, also to understand when and how a finance charge and late fee is applied. We are going to be calculating the minimum payment using some different methods, as well as understanding calculate finance using some different methods. Let's go ahead and look at some terminology related to finance charges and credit cards. What happens if you have a balance due? It's not paid in full. Well, if you carry a balance from a previous billing cycle, you will incur a finance charge from the credit card company. The finance charge is calculated using the annual percentage rate, the APR, and one of the different methods that is acceptable. And we'll be looking at a few of those methods today. If you did not carry a balance from the previous billing cycle, you will have an opportunity to pay your full balance within a grace period. It's a time where you can pay your balance after the due date, but still avoid a finance charge. However, remember that if you have some transactions like cash advances, you won't receive a grace period. If you don't pay your balance in full, your next billing statement will include a finance charge. Let's talk about minimum payments and late fees. You must make the minimum payment listed on your billing statement before the payment due date to be considered current. Otherwise, you will be late and you will be charged late fees. The minimum payment is calculated as a percentage of your credit card balance, and we'll be looking at some different ways that minimum payments are calculated. If you pay less than the minimum, or you make the payment after the due date, your payment will typically be considered late, and like I said, you'll be charged a late fee. If you are more than 30 days late, then you'll have a late payment notice that will be added to your credit report. And this is not good because that impacts your credit, that impacts your FICO score, and your ability to take out a loan. When you make a credit card payment, the amount is then subtracted from your balance decreases, and your available credit increases. So the amount that you can continue to borrow goes up. For example, if your balance is $200, your credit limit is $300, and you make a payment of $50, your balance goes down to $150 that you owe, and your available credit would then increase to be $150. Let's look at how we can calculate the minimum fee. Now, the minimum fee is the minimum amount that you are required to pay each month. So let's look at the percent plus fee method. That is one way that it's calculated. In this method, your credit card balance is multiplied by a percent, typically somewhere between 1 and 3%. Then any late fees you have incurred are added to that balance. So let's do an example. Say you have a balance due of $1,000 and your minimum payment is 2%. Well, you would just take the $1,000 and you would multiply that by 2% as a decimal. And you would get $20. So your minimum monthly payment would then be $20. As long as you continue to just make the minimum monthly payment and add no more new purchases, you would eventually pay off the balance due. But you can see that it would take an awfully long time if you only made the minimum payment. Okay, let's look at another method. This method is called the percent plus finance charge method. This method takes into account finance charges or interest charges. Late fees are also added to this method as well. So it's very similar to the previous method. Let's look at an example. In this example, your balance due is still $1,000, but this time your minimum payment is 1% of the balance due. Plus, your interest rate on this credit card is 12%, and you owe no fees. So let's calculate your minimum payment. We would start off with $1,000, and we would multiply that by the 1% to get $10. But then we have an interest rate of 12%. That's 12% per year. So we would need to take 12% and we would need to figure out what that is per month. So we would take 0.12 divided by 12, and we would get 0.01. So in order to find our interest, we would take our $1,000, multiply it again by 0.01, and we would get another $10. In this case, our monthly minimum payment would be $20. Same as before, only this time it's allocated between interest of 12% per year and a 1% minimum payment. Now let's look at finance charges. How do we calculate finance charges? There are multiple methods, at least 5, and we're going to be looking at 3 today. The first one is the adjusted balance method. And this method uses the balance at the beginning of the billing cycle and subtracts any payments that you make during the current billing cycle. So this is the least expensive method for you. Let's try an example. In this example, we'll say we have an ending balance of $1,000 again, and then we made payments of $100 during the next cycle. Our annual percentage rate is 14%. So let's calculate our finance charge. In this example, we would have our $1,000. From the beginning of the billing cycle, we would subtract any payments made during the next billing cycle, which would be 100, and we are left with 900, which we would pay a finance charge of 14% per annum, or per year. But remember that this is monthly, so we would need to take the 14% and divide by 12 months to figure out what the monthly percent is. So in our calculator, we would take 0.14 divided by 12, and we get 0.011667. I'll just round to 0.012. Okay. In order to figure out our finance charge, then we would multiply the 900 by this 0.012. So I will just hit times 900. And our finance charge in this situation is only $10.50. Let's go ahead and look at another method. This method is the average daily balance method, which you will be exploring next week. This method uses the average of the balance during the billing cycle. So it takes into account each day's balance, and then it finds the weighted average of that. Let's look at an example. If we have a 30-day billing cycle, and we say that our average daily balance was 183, so we have calculated that, and our annual percentage rate is 12%, we can find out our finance charge by again finding the monthly rate, so 12% divided by 12, which we know comes to 0.01. And then if we just multiply the outstanding balance by 0.01, we will get our finance charge. And that comes to $1.83. And that is the average daily balance method. But again, remember this average daily balance needs to be calculated, and we will be going over that next week. Let's look at a final method here. Let's look at the ending balance method. In this method, we use the balance at the end of the billing cycle. So we take in the beginning balance, which is adjusted by payments, any credits, and any new charges to come up with an ending balance. So let's look at another example. In a 30-day billing cycle, our previous balance was $1,000. We had payments of $100, and then we had a charge of $50, all in the next cycle. Again, our APR is 14%, which we've already done the calculation for that. We know that 0.14 divided by 12 is 0.012. Okay, here we start with 1,000. We subtract our payments of 100 to get 900, but then we need to add any new purchases onto our balance to get a balance of 950. So this 950 is what we will calculate our finance charge on. So we take 950, multiply that by our monthly rate, and we will come up with our finance charge. So 950 times 0.012 will give us $11.40. So you can see that there's many different methods for calculating the finance charge and the minimum payment. And that's why it's important for you to do your own research when you are taking out a credit card, especially if you're going to carry a balance, to see which one would work best for you. And this concludes our lesson today on credit card finance charges. So hopefully at this point you feel more comfortable with some of the terminology related to credit cards. You can understand when and how a finance charge and late fee is applied, as well as calculate a minimum payment using different methods and finance charges.